This one stock could change early buyers' lives. I'm not a financial advisor, but some financial advisors might say to buy as much as possible before December 31st. Guys, what I'm about to show you could be the difference between making life-changing money in 2026 and watching your portfolio get crushed in an AI bubble collapse. We're heading into 2026 with the most unusual setup we've seen in decades. The Federal Reserve's money printer is back on. $500 billion in tax refunds are about to flood the economy. And while everyone's piling into overpriced AI stocks, there are 6 massively undervalued stocks that no one's talking about. Today I'm breaking down all 6 tickers: EAT, AIG, BMY, LVS, STLD, and VRTX. And then I'm going to show you why EAT, Brinker International, the company that owns Chili's, could legitimately be the most mispriced stock in the entire market right now. Now, I know what you're thinking. A restaurant stock when everyone's talking about AI? Yes, and by the end of this video, you're going to understand exactly why. I'm not a financial advisor. This is educational content. You must do your own due diligence. But what I'm about to show you is backed by hard data and macroeconomic forces that are undeniable. If you find this valuable, smash that like button and drop a comment letting me know which of these 6 stocks you're most interested in. Let's go. All right, let me break down the 3 massive forces converging. Force number 1, the Fed's money printer is back on. The Federal Reserve is cutting rates, and this changes everything. When the Fed cuts rates, borrowing costs decline, M&A explodes, IPO markets reopen, and asset prices rise. But here's the specific opportunity. For 2 years, we've had an inverted yield curve. Short-term rates higher than long-term rates. This crushes bank profitability. Banks borrow short and lend long. When short rates are higher, they lose money on every loan. Now the curve is normalizing. The Fed is cutting short-term rates while long-term rates stay elevated. This is exactly why financial stocks like AIG need to print money again. AIG, American International Group, is an insurance giant that's been restructuring for years. Nobody cares about it. It's boring. But with Fed rate cuts, the yield curve steepening improves their investment portfolio. M&A activity means more insurance demand. Deregulation reduces compliance costs. And AI data centers need massive insurance coverage. AIG benefits from the Fed liquidity without any AI hype valuation. Same with BMY, Bristol Myers Squibb, trading at 8 times forward earnings with a 5% dividend. Everyone's scared of patent cliffs, but with Fed rate cuts, pharma M&A explodes. Big Pharma has $1 trillion in cash and needs to replace expiring patents. Lower rates make acquisitions cheaper. BMY either acquires or gets acquired. At 8 times earnings, you're getting paid to wait. Force number 2, the $500 billion refund tsunami. Now here's the big one. The largest tax refund season in American history. The One Big Beautiful Bill Act was signed July 4th. It made massive tax cuts retroactive for 2025. But the IRS never adjusted withholding tables. So every American has been overpaying taxes all year. When people file returns in spring of 2026, the IRS gives all that money back in one lump sum. The scale, $100 billion to $150 billion at a minimum, up to $500 billion. Average refund increase, $2,000 to $2,300 per household. Here's the critical part. This money goes predominantly to the top 20% of earners. These are people who don't need it for basics. They're going to invest it or spend it on discretionary items. What happened during COVID stimulus? Total stimulus, $931 billion. About $100 billion went straight into the market in days. The results? NASDAQ surged 49% in 2020. Another 28% in 2021. Apple up 82%. Amazon up 79%. Tesla up 394%. But here's what's different this time. We're not in lockdown. COVID money went to Zoom, working from home. Peloton, home fitness. Netflix, stuck inside. 2025 refunds go to restaurants. That's EAT. Casinos and resorts. That's LVS. Experiences, not stuff. This is why EAT and LVS are perfectly positioned. Force number 3, AI infrastructure without the hype valuation. AI CapEx 2025, $320 billion. 2026 projection, $520 to $530 billion. And this week, OpenAI announced raising $100 billion. Largest private round in history. This isn't VC money. This is sovereign wealth fund money. Saudi Arabia, UAE, Norway. What this tells us? The AI build-out isn't stopping. The financing gap just opened wider. But everyone's buying NVIDIA at 26 times earnings. That's crowded. The real money is in second-order plays. STLD, Steel Dynamics. Everyone talks about AI needing GPUs. Nobody talks about AI needing physical buildings. Data centers are massive steel-intensive construction. 12-year backlogs on power transmission means companies are paying premiums on construction solutions right now. Steel Dynamics is the lowest cost steel producer in North America, trading at 6 times earnings with a 2.5% dividend. Benefits from AI infrastructure build-out. While everyone fights over NVIDIA at 26 times earnings, STLD trades at 6 times and benefits from the same AI boom. Let me talk about healthcare for a second, because this is setting up beautifully. Healthcare has been a dog for 3 years. That's exactly why it's interesting. With the Fed cutting rates, biotech M&A is about to explode. Here's the stat. Nearly half of publicly traded biotech companies trade below cash. Below cash. Meanwhile, Big Pharma has trillions of dollars in cash and needs to replace expiring patents. Result? Biotech M&A. VRTX. Vertex Pharmaceuticals isn't speculative biotech. They dominate cystic fibrosis. 90% plus of patients on their drugs. Massive recurring revenue. Expanding into pain, kidney disease, diabetes. They've got cash to acquire smaller biotechs. Quality growth at reasonable price with M&A tailwinds. BMY, Bristol Myers at 8 times is pure value. New pipeline products accelerating. Developing a GLP-1 competitor for the $100 billion obesity market by 2030. Downside limited, upside massive from any success. All right, now let me explain why EAT is my highest conviction play out of the 6. Current price, around 150. Market cap, about 5 billion. Forward PE, 13 times. What they own? Chili's, 1,600 locations. And Maggiano's, 50 locations. The perfect storm for EAT. Number 1, the refund catalyst. 500 billion hits February through March 2025. Top 20% earners get $2,000 to $2,300 checks. These people eat out regularly. Unlike COVID, which helped Zoom, these refunds help companies benefiting from people going out. Number 2, the turnaround is working. Chili's same-store sales up 14% plus. Not from pricing, from traffic. More customers. How? They went viral on TikTok. Gen Z discovered Chili's. They doubled down on value while competitors raised prices. Their 3 for Me deals became a phenomenon. They're taking market share from fast casual. Number 3, margin expansion. Restaurant level margins went from 11 to 12% up to 14 to 15%. Digital ordering reduces labor costs. Menu engineering drives higher margin items. Better operations. Number 4, the valuation disconnect. 13 times forward earnings. Growing 29% plus annually. PEG ratio, 0.65. Anything under 1 is considered undervalued. Compare this. Domino's, 25 times earnings. Chipotle, 45 times earnings. Eat is growing faster and trading at half the multiple. Number 5, uncorrelated to AI. If NVIDIA crashes 50%, people still eat at Chili's. If OpenAI implodes, families still go out to dinner. It's a diversification play disguised as a value play. Number 6, the catalyst calendar. Q1 earnings in February. Strong holiday numbers. February through March, refund checks hit. Traffic spikes. Q2 earnings in May shows the refund impact. Summer, the experience economy strength. Q4, potential guidance raise. Multiple expansion. Number 7, the risk reward. Let's be honest about risks. Consumer slowdown. Competition. Execution could falter. But here's the calculation. Downside, stock falls 20 to 30% if consumer cracks. Upside, fair value 200 to 250 if turnaround continues. That's favorable risk reward. Number 8, why this changes everything. NVIDIA at 180 needs to hit 1800 to 10x your money. EAT from 150 to 250 equals a 67% return. And it could actually happen. Plus, everyone's looking the other way. While investors pile into AI at 50 times sales, nobody's watching a 1,600 restaurant chain crushing comp sales and expanding margin. That's the opportunity. Let me talk about LVS for a second, Las Vegas Sands, because this is the perfect refund play. When people get $2,300 refund checks, they spend some on experiences. Vegas trips, Macau gambling, premium entertainment. LVS positioning, 70% of revenue from Macau and Singapore, not US dependent. Premium customers equal higher margins. Trading at 15 times forward earnings. Convention business at all-time highs. The experience economy is exploding, and LVS captures premium spending. All right, let me give you the action items. What to do before December 31st. Number 1, clean up your portfolio. Sell the hold and hope positions. If you wouldn't buy today, don't own it tomorrow. Number 2, think smart about taxes. Tax loss harvest, but don't sell winners just to harvest losses. Number 3, position for refund season. The money hits February through March, so be positioned by January. EAT and LVS are the plays. Number 4, don't chase AI at these valuations. Buy STLD at 6 times instead of Nvidia at 26 times. Number 5, rotate into unloved sectors. AIG, VRTX, BMY have been dogs for years. That's why they're mispriced. Number 6, be prepared for all outcomes. Your portfolio should work if markets rip higher, grind sideways, or drop 20%. Number 7, think bigger picture. 2026 is about 3 to 5 year trends, not quarterly results. All right, let me bring this home. The setup is crystal clear. Fed's money printer is on. And if I could only own one stock for 2026, it's EAT. Here's why. The refund catalyst is perfect. The turnaround is already working with 14% plus comps. Margin expansion is real. It's trading at 13 times earnings for 20% plus growth. It's uncorrelated to the AI bubble. And it's got a 2-to-1, 3-to-1 risk reward setup. While everyone's chasing Nvidia at 26 times, this is a restaurant chain at 13 times that's perfectly positioned for the refund storm. It's not sexy. It's not going to make you sound smart at parties, but it just might make you money. And at the end of the day, that's what actually matters. So there you have it. EAT, AIG, STLD, VRTX, BMY, and LVS. 6 stocks, 1 clear winner, EAT for 2026. Do your own due diligence, size your positions appropriately, and position yourself for what's actually happening in 2026, not what everyone's talking about on social media. If you found this valuable, hit that like button, drop a comment saying which stock you're most interested in, and hit that subscribe because we've got a lot more coming. And if you want to see the exact system I'm using to trade this, the one I'm testing with my own money, head over to stockscommunity.com. You can join for 7 days for $25. Thanks for watching. I'll see you in the next one. And remember, quality, quality, quality. Let's go make some money in 2026.